This afternoon, we are joined by three of our speakers, and firstly, I'd like to invite on the stage Professor Sundar Ram Koravi, Dean, National Institute of Securities Markets. Can we have a huge round of applause to welcome him? His interests are in the fields of financial economics and fixed income securities, and he's also lectured at several institutions of national importance, such as the National Institute of Bank Management, National Insurance Academy, Institute of Chartered Accountants of India, National Academy of Direct Taxes, and NITI. Moving on, our next speaker for the session is Mr. P.S. Reddy, Managing Director and CEO, CDSL. Please help me welcome Mr. P.S. Reddy on the dais. He joined the Central Depository Services India Limited in November 2006 as a Chief Operating Officer and has been elevated to the Managing Director and CEO post in April 2012. Our final speaker for the session, please help me welcome on stage Ms. Anuradha Sriram, Director Benefits, Towers Watson. She's responsible for the Towers Watson India team to deliver value-added actuarial and employee benefits consulting to both domestic as well as the multinational companies, and she comes with 14 years of experience in the Indian insurance and pensions business. Now, as we all know, this is a post-lunch session, and many people call it as a graveyard session, but this definitely is not, because we're driving a very important topic. So let's have a huge, enthusiastic round of applause to welcome three of our fabulous speakers. And let's drive the conversation. I'm going to hand over the session to Professor Sundar Ram. Over to you, sir. I'd like to request the team member from the console to also set up the laptop. Ms. Anuradha has a presentation to share with the audience.
Very good afternoon to all of you. So while we are getting ready for Ms. Anuradha to set up her presentation, it's my pleasure to give you some of my initial thoughts, in the sense that outside of this room and in the rest of the world, the biggest news which is going on is Greece. It's a classical case where people are entrenched to their jobs and rather vociferous protests on the street, and downsizing is a problem, and if you cannot downsize, then there is a pension bomb accumulating. Used to long periods of not collecting taxes, and therefore the fisc is out of shape. And in such a situation, what happens is the pension liabilities keep increasing. You are not able to trim the workforce. The tax revenues are not there for the government. And finally, what you see is a mounting pension burden. As far as India is concerned, we have some low-hanging fruit in terms of the organized sector already having an appetite for new products, and pension products are certainly one of the products on the anvil, on the minds of people. We have seen some attempts by the government at bringing in financial inclusion in the pension sector, because so far more publicity has been given to financial inclusion on the banking side, but what about the other products? And coming from academics, one of the classic works by Stiglitz and Atkinson show that insurance and pension markets in India are not developed because we have a great institution in India which is called the joint family system, which existed for much of the 1970s. And therefore, because of this, pension and insurance were not really considered. But now with the establishment of nuclear families, one breadwinner in a family, and pension really matters, and life insurance really matters. So we are going ahead with a state-run insurance plan and a state-run pension plan, and over a period of time we get into the private mode. So it is with these words that I welcome both my panelists, and we'll have a free-flowing interactive session. We expect some audience participation also. But first, Anuradha would like to lay some framework for this session by making a presentation, and then after that we'll have a free-flowing panel discussion. Yes, please.
Thank you, sir. Indeed, it is a tough time getting people post-lunch session to listen. I'll try to make this as interesting as possible. So this is really to set context of the Indian pension landscape in the global pension landscape, and I'm going to present to you some Towers Watson research on global pension landscape, which will really put things in perspective in terms of where we stand from an India standpoint, and what is that we need to be thinking about, really to set the context, and then we'll have a discussion going forward, a free-flowing discussion, And we do have Q&A at the end of the session, so please feel free to park your questions until the end, and please feel free to raise those questions. With that, what Towers Watson does is, on an annual basis, we look at the top 29 pension funds globally, and we do a study of these global pension assets. We look at the size of the assets, we look at the investment classes in which these assets are invested, we look at the rate of growth of these assets over a period of time, and we also look at the rate of return of these pension funds, and also how do they compare versus the GDP of the country. So it's a comprehensive study of the global pension assets, just for us to understand how these top pension funds compare to the GDP of the respective countries, and where do we stand in terms of the India pension landscape. So just for all of you to understand about the study a little better, this covers 16 major pension markets, and there's a total pension assets of 36,119 billion in pension assets, and compare that to a high level estimate which we have of pension assets in India, comprising of all the formal sector pension assets like a gratuity or a superannuation or a NPS or a provident fund, etc. The total of that, as per our estimate, is probably $250 to $60 billion. Compare that to the 36,119 billion pension assets that we are talking about, and on average they work to around 84% of these economies, which is quite sizable. And even countries in the Asia Pacific region are ahead of us. For instance, Hong Kong and Australia are much ahead of the curve in terms of how they are in terms of the global pension assets. And also what we have done in terms of the study is to look at the assets for the top 6 assets, as well as top 7 assets, as well as the top 16 assets. So just a quick summary of the assets as per the latest study, which is based on December 2013 numbers, which was done in 2014. So the total, like I said, is 36,119. The increase has been 6.1%, and not surprisingly, US is the largest asset globally, and US alone contributes to nearly 60% of the global pension assets, and 49% of the US assets, as per the study, is DC schemes, and then followed by UK, which is probably around 9% of pension assets globally, and then you have Japan, which has around 5% of assets. All of these 3 countries put together account for 78% of the total assets. So that's the order of pension assets from these 3 countries in the top pension assets. And this is also giving you a perspective in terms of the CAGR in the respective countries over these 10 years across the different countries. This is also giving a perspective in terms of how the pension assets are versus the GDP in the local currency. And also from a focus perspective in terms of these global pension assets, these are some of the themes that we are seeing emerge, and which is very contextual from a discussion today perspective. In terms of the focus areas from a governance standpoint, from a risk mitigation standpoint, from a risk management standpoint, we do see that there are, even if the size of the assets are so large, these points are even more important for these assets, and we are seeing that these are the elements which are emerging as key focus areas for these global pension assets in terms of improvements in governance, risk management focus, and there's definitely a move from a defined benefit pension scheme to a defined contributions model, and there's definitely pressure for talent, and there's a new value chain which is coming, and definitely there's a new ideology emerging in terms of how the investment is being looked at. So these are some of the key focus areas in terms of how the global pension assets are being managed, or what is the priority of these global pension assets. So now, just to put things in perspective for India, not surprisingly, we have very little social security and low mandatory benefits. If you look at the corporate sector, we have just the gratuity and the provident fund, and we did some simple modeling where we found that gratuity and provident fund alone taken into account will provide less than 30% of net replacement ratios for an individual, assuming he stays in service and he doesn't draw this gratuity and provident fund before leaving service, which is highly unlikely in the Indian context, because anecdotally we know that 70 to 80% of provident funds get withdrawn before the retirement age. Here I'm not making any comments on the governance framework in terms of the plan design and allowing withdrawals to be made, but just to put the point forth that from a net replacement ratio perspective, our mandatory benefits do very little in terms of accumulation for retirement. And from a corporate standpoint, we've seen that, I work in the corporate space a lot, and we've seen that employees have a very cash driven approach and they don't really think about saving for retirement. And that's where NPS also struggles a little because if you go and offer this on a corporate platform, very little percentage of employees actually take it up because they don't really relate to this concept of long-term saving. And that's something that we have to be working together to bring that awareness. In fact, Sumit was there in a session that we did recently, and we had a set of clients in the room where we spoke about the need for long-term savings and the poor net replacement ratios that we have and what is that companies can be doing in that context, and we positioned NPS as a platform that could be looked at in this context. And based on our estimates, Indian pension assets are hardly 10 to 12% of GDP, which is something that we have to be really working upon to see what is that can be done. So with that, I will thank the audience for a patient listening and pass it on to Mr. Reddy to make some opening remarks.
Thank you, Anuradha, and over to you, Mr. Reddy, on some opening remarks related to the regulatory landscape for the pension sector.
Thank you, Mr. Sundar. Let me thank also the Economic Times for giving us an opportunity to speak on this forum. I would like to comment on three things related to the product, especially the NPS or the pension as such. One is the distribution, second is competition, third one is product and process innovation. These are the three areas which I would like to talk about. I fail to understand as to why the distribution network which is already existing, which is already in place, thriving in various other financial products, is not being used effectively by the regulator. Now, I also know the reason why it is not being done, because the sectoral regulators have drawn the lines saying that so and so entity is regulated by me, and this entity cannot get into in marketing or servicing other products. Probably the FSLRC recommendation for a unified regulator will help in leveraging the existing distribution network. I can give you a small example. Today the depositories have, maybe at least CDSL has about 11,000 point of services, and so is NSDL, which is a competitor, and we have the largest network of DPs. We have 580 depository participants. Now imagine if somebody has to set up a new network and then market these products, probably it will be expensive. But if a depository participant who is already has a shop and who is already anyway incurring a lot of fixed expenditure or recurring expenditure, it is just another product that he can service, and the distribution costs can be substantially reduced for popularizing the NPS. And now this is one important thing that the regulators should come together and look at it, how optimally leverage the existing distribution network to market any of these new products cost effectively. Anyway, they are all regulated entities and they can always pull them up if things go wrong. And this is one thing which is not happening. And the single demat account for all financial assets was proposed by the government in the budget. If once that happens, probably this kind of synergies can be, can be derived if once that is implemented. Having said this, the second area, that is lack of competition, is which again is worrying. As a regulator, it's not the responsibility of the regulators to look at there should be a 1 player, 2 players or 100 players for any product. Their job is to just lay down the principles for entry and exit, or the rules that relates to the entry and exit. For example, CRA is one business. There's a monopoly in the CRA business, and CDSL has been in this domain, want to operate. And way back when they were having about 17 lakh Government of India accounts, that is essentially the employees of central government, and we have given a tariff when the tariff was 280 rupees AMC versus we have offered 100 rupees. We have shown to the government, the ministry, that a straight about 28 crores saving per annum to the Government of India. And the Government of India at that time was very positively disposed, so is now. They have written to the PFRDA, but the regime in PFRDA in the past, I am talking about the past, did not positively incline to have, because they say that the market is small, this one CRA is more than enough. And our argument was, who are you to decide whether one CRA, 2 CRAs? Your job is to lay down the principles for operation, exit, entry, and then leave it at that. And the current the disposition at the current regime in PFRDA very positively inclined. They are looking at the act provided for it, and they are looking at a second CRA. It's not one CRA, 2 CRAs. Those who have deep pockets, those who wants to play a long-term play, they should be allowed to compete and make sure that the benefits are given to the investors. The third point that I want to make is on the process and products. The products that are introduced by the today PFRDA itself is seen to be a owner of the NPS. Okay, now it's a regulator. As a regulator, job is to lay down the regulations and then say somebody else will be devising the product, making the product, selling it, and making it a success. Now it's in a very peculiar situation where PFRDA itself is marketing and doing this. Maybe it is the government's mandate. I appreciate that. It's a good scheme, NPS. There's no doubt about it. But there should be there's an NPS trust which is supposed to be the owner of it, and they should be undertaking some of the activities. And as PFRDA, maybe much of it is to do with the regulation and securing the interest of the investors or pensioners. On the product and process, for example, the current NPS thing says if you don't pay for 6 months, there will be a penalty. I don't think if we are looking at an informal sector, such kind of a deal should not be there. There should be enough flexibility for the people to come in and contribute as and when they have money. The other thing is that currently all the investors or all the pensioners have to contribute to the POS. Why can't there be a direct account? Once I admit myself in the NPS, I should be allowed to contribute directly. Why should I pay any service charges to the POS? This kind of innovations in processes and products should be provided for the success of any of the schemes. But my focus is PFRDA as a regulator should lay down a very fair and equitable and transparent rules and to make the system work the way that it is intended to.
Okay, thank you, Mr. Reddy. You raised a very important point on the role of PFRDA as a developer, as of the markets, deepening the markets, as a producer and designer of a product, and also having a regulator. Similar types of questions are being raised that, let's say, a central bank having a role of stabilizing on inflation and also being the merchant bank of the government bond. So such type of regulatory points have been raised in the public domain. Now, extending the talk on NPS, Could we have your comments on certain innovations which you may like to see?
Yeah. See, on the NPS, again, NPS is seen as a product that is meant for the masses. Now, it's substantially for unorganized sector. I am not able to honestly understand why the taxation should come in the way. There's many speakers have said EET is the exempt and tax is something that bothers. Now, what kind of income that these masses are going to get if it is taxed? Is anyway it is getting exempted when that money comes as income. Okay, I don't think that what I mean is they are anyway going to be under the tax exempted limit. So why should the EET should be a concern for popularizing the NPS? Maybe for others, those who are going to get good amount of money. The other one is it should be made definitely a mandatory product, especially under the Shops and Establishment Act, which is every state has it, and there are many shopkeepers very meagerly paid, and if they make it a point under the Shops and Establishment Act that all the shopkeepers and their employees who are 2, 3, 1, whatever it is, now they should necessarily open an NPS account and contribute every month. Maybe for 6 months they may not be in job. There should not be any penalty for such kind of such kind of contributions. So that is, it should be made mandatory. So is under NREGA, the direct benefit transfers taking place under NREGA also. Probably wherever there is a NREGA kind of account, government should contribute, and a part of it should come through come for NPS. So unless it is made mandatory, as earlier speakers also said, it will not be as successful. The other one is the 1,000 rupees per month. That's what we see newspaper. It is very unlikely to attract people. I'll tell you one thing, which I collected some information. To define a poverty line, under Professor Suresh Tendulkar committee has recommended in 2011-12, 27 rupees per day in rural areas and 33 rupees in urban areas, which works out to be 9,855 rupees per annum in rural areas and 12,000 rupees per annum, 12,000 rupees, 45 rupees in urban areas. If that itself is the poverty line definition, how can 12,000 rupees per annum will help in attracting the people? Will it really, after 40 years, by the way, not now, okay? Now, will it remain, will it keep the people above poverty line? I wonder. So we must be realistic when we are talking about pension. 1,000 rupees does not attract people, so it should be something meaningful. Now, again, there's a Professor Rangarajan committee is there in 2014-15. They recommended 32 rupees in rural areas and 47 rupees in urban areas. That works out to be 11,680 rupees per annum in rural areas and 17,155 rupees in urban areas. So 40 years down the line, can you imagine? These are the figures. These are the poverty thresholds to define somebody is below poverty or not. These are the poverty line thresholds. So the NPS scheme does not take into account, this is my belief, understanding, that these numbers have to be taken into account when they define minimum pension. If pension is not the main source of income, it is just add on to them, that's a different matter. But I suppose the pension income that they are talking about is the substantial income for the family to get along. The other issue that I would like to talk about is now in the NPS advertisement I saw that the nominees after the death of the pensioner, his spouse will get again that pension. After the spouse demise, the nominees will get 1.7 lakhs to 8.5 lakhs or something. Now, when the pension itself is so low, why at all you provide for the nominees getting 1.7 lakhs to 8.5 lakhs? This is where the product improvement and the innovation that I am talking about. Why don't you increase? You say that there is no payout at the end of the demise of the both the households, both the wife and husband. Probably they can provide for a higher payout out of this, and that is again product innovation that we must look at it. Instead of giving out to the children, maybe at the age of 60, the children must be on their own. You know, I don't think that they expect them to get some kind of income post demise of the parents. So these are the few thoughts that I have on the NPS.
Actually, in a discussion like this, when we look at regulation, there are two things. One is the regulation as it is today, and the regulation as it ought to be. So in that context, Mr. Reddy has raised a very important point, in the sense that if we've got to improve the design, these are all issues in design. If we ought to improve the design, then most of the discourse in the public is about the EET, where Mr. Reddy has said that insofar as those who are far below in the income levels, taxation is not a design issue. And one empirical study which is in support of what Mr. Reddy has said, that 1,000 rupees, as far as the contribution are concerned, there are many persons, particularly in Uttarakhand, where a study had been taken, that the monthly contribution is, let's say, X rupees. By reducing that X rupees by a few notches, then a large number of people can actually come into the net. So affordability is an issue, and some more study has to be done before we actually take the minimum contribution as the holy grail. Now over to Ms. Anuradha. In your opening slides, you had mentioned that India lags behind even compared to Asia, and there's an epochal change not only in India but other places from DB to defined contributions, and that insofar as India is concerned, it's only 10% of the GDP. Now with that in the context, what is the global standard, or in other words, which country's model is the most suitable to emulate? Let's say India is at a nascent stage. Who do we take as a model to emulate?
Right. So,
is it down? That's on.
yeah. So, is it audible?
Yeah.
So, if you look at it in terms of what regulatory frameworks to emulate, we have been traditionally a country which has not gotten into too much of a defined benefit arrangement, except maybe the defined benefit pension schemes that exist in the public sector. If you look at the unorganized sector or even the organized private sector, it's been largely a defined contribution arrangement, except for the gratuity benefit that we have, which is a final salary linked gratuity benefit, and based on our understanding, 50% of the companies provide gratuity as per Act provisions, which means that it's capped at 3.5 lakhs or 10 lakhs now since 2010. So we are largely a defined contribution kind of liability that we have in this country. So I think taking that into context, I think probably the LATAM or the Australian models are something to look at in terms of the regulatory framework, and the Australian model is something to really study closely. And I'm sure post the OASIS study was done, and before the NPS framework was put in place, these models were looked at, and we have emulated from the Australian framework in terms of the open architecture that's there, the multiple super funds that are there, and Australia is the third largest pension market that ways, and even the LATAM model also is very similar to the NPS framework that we have. So I think these two markets are and the regulatory framework is something that we can continuously look at and see how they have evolved over a period of time, and what is it they have done to incentivize. If Australia has been able to grow to a size and it's the third largest pension market, they should have done something right in terms of taking this to the masses, incentivizing take up of this benefit, and also incentivizing the multiple stakeholders in that open architecture to make it sustainable as well. So I think those are things for the PFRDA to look at in terms of sustainability to stakeholders, incentive and attractiveness to the participants in terms of taking this up. It was done through a combination of awareness to the stakeholders, and it was also done in a manner which was largely retail oriented and not a corporate oriented kind of approach. If you look at the Australia model, where it is really retail investment done by individuals rather than corporates providing that kind of a savings, because corporates only can do so much from a liability standpoint. They wouldn't want to get into something that they are not able to sustain from a business standpoint. So a retail approach, incentivizing, making it attractive, and also something that's sustainable for the different participants. For instance, the pension fund managers keep talking about the pension fund management charges needing to be more sustainable to make it attractive to the participants in the framework as well. So I think those are things for the stakeholder to think about from a regulatory standpoint.
Okay, thanks. Now you've also we've talked about consumers. Now instead of looking at the consumer of pension in one monolithic way, can you help us to look at consumers in a more analytical or granular way? What are the different types of consumers, or what are the perceived risks, and different consumers have different perceptions of risk appetite. So can you throw some light on that?
Sure. So I would actually put consumers into three groups. One is organized sector, and second is the unorganized sector, and third is the poor and the below the poverty line people. So based on my experience, I would probably like to talk about the corporate sector and request Mr. Reddy to probably make some comments about the other two
corporate
consumers.
NPS, yeah.
So from a corporate segment perspective, if you see the segments that exist in terms of attitude to pension savings and investments, we have seen that NPS has not really been taken up. It's only as per the latest information that we have, probably 1600 odd companies have prescribed to NPS, while the scheme has been introduced some time back, and even in those companies that have prescribed to NPS, the take-up has been very poor. So it's been probably, on average, the experience has been probably 8 to 10% of the employees in every company only take up NPS, which means that the number of subscribers that is coming through the corporate NPS scheme is very poor. And we are still a very young country, and sub 35, the attractiveness of NPS is still very low. And while all that is said from a corporate consumer perspective, I think all of us have a responsibility to create awareness. And like I said, pension assets is only 10 to 12% of GDP, and we have done some modeling and we have done some assumptions in terms of the inflation that is likely to be prevailing in the future, the cost of living, the level of savings, etc. And we have looked at what is the net replacement ratios that individuals are likely to have at the time of retirement in future. And we find that the retirement replacement ratio is, especially in the context of nuclear families, is really abysmal. And when we are looking at education costs going up at 2.5 times price inflation, medical inflation being plus 4% price inflation, etc., sustainability post-retirement to meet medical costs and longevity improvements is something that everybody needs to start thinking about. And there's a huge collective responsibility that all of us have to create that awareness, to show the poor net replacement ratios that we have, and the need to start investing in such long-term investment platforms. So that is a point of view I have from a corporate consumer
NPS.
standpoint.
Okay. Mr. Reddy, can you help us to look at the consumer base analytically?
Yeah. As Ms. Anuradha said, in the case of unorganized sector, one is the self-help groups that are there will help in promoting the NPS. Fortunately, we have a chairman, or rather MD, chairman, former chairman, and MD, also current MD of Seva Bank is on our board, and that self-employment women's association, probably many of you are aware, which is a Gujarat based organization, and they are actively promoting NPS, and gradually, literacy is increasing, awareness, not so much literacy, but awareness is increasing, and somebody is there to guide them in promoting the NPS. The second one, which is very important, is again I highlighted in the earlier. Distribution is very important. Today, an LIC policy or insurance policy is sold like anything in a village, because even a small priest, okay, he comes home, he does perform all the things, and at the end of it he will ask, why don't you take one LIC policy? Because he happened to register as a distributor, and there is an incentive for him to sell that product. And distribution is key, and I repeat, distribution is key, and everybody and anybody can sell any product provided the distribution is in place. I do not say that we should encourage any dishonest ways of unethical selling, but I don't think there is anything that can go wrong here. And my view is this is to help the masses, so distribution network must be strengthened. Until then, it will not reach all and sundry as we are proposing to do that.
Okay. The question to Ms. Anuradha is that if I am a lay consumer of pensions, there are pension products by life insurance companies, and there are pension products from standalone pension providers. So, since you are the actuary in this group, how do you see it?
Right. So, typically, if you see in an open architecture currently in NPS, I will talk about it in the NPS context. So, we have the pension fund managers who take care of the accumulation phase, and then we have the annuity service providers who look at the deaccumulation phase in terms of annuity payouts. And typically, if you look at it in the insurance context, the assurance business and the annuity business are naturally hedged, which means that assurance, there's a mortality element, whereas annuity, it's a longevity element. So, which means that for an insurance company to have the accumulation phase as well as the deaccumulation phase has longer economies of scale in terms of fund management. So, I think if the pension fund managers are also allowed to provide annuities as a standalone pension fund, standalone annuity service providers, that would help to keep the funds for a longer period of time, enable economies of scale, and that's an innovation that probably the PFRD can think about in terms of allowing the pension fund managers themselves handle the deaccumulation phase as well, which would make sense in terms of having the funds for a longer period of time, and that can translate into economies of scale and better rates of return to the provider. Because if the fund has been with the pension fund manager until a point of time and then it transfers over to an insurance company, there could be some challenges from a economies of scale perspective, as well as the investment flexibility and the volatility and liquidity, etc. So I think that's something that the PFRD can think about in terms of the accumulation and deaccumulation being with independent providers or all being with a single provider, which would make sense. Definitely leave the choice to the consumer, but this is one model also that could be looked at from a regulatory framework standpoint.
Thank you. Then I turn over to Mr. Reddy on the point that you have a SEBI, you have an IRD, you have a PFRDA. So what do you think should be the way of smoothening the tensions between these different silos?
Well, we would not come to know whether there is any tension among themselves, but they may be in a closed door meeting, they may be settling it. Now that FSDC is there, and somebody will be a referee and then others will be the players and settling the scores. But it's important that at the end of the day, consumer, for whatever the industry that they are serving, they must keep that in mind. And it's not just the domain that they should keep in mind, but across the domains, that capital market, pension products, insurance, banking, all these areas they should keep in mind, and then see wherever there is synergy, they should cooperate, they should allow the players regulated by one entity to smoothly market and the market service, whatever it is, the other products of the other regulators. Unless that is done, I don't think there is we are going to go as much as we want to be.
Okay, back to Ms. Anuradha. We would like to come back to that issue of funding healthcare on a post-retirement basis, and there is this reality of longevity risk, which is there, better healthcare, better life expectancy, and we also have products that are bundled and unbundled. So, what are the possible solutions? Because in the post-retirement scenario, healthcare would be the major element.
Yeah, so I think bundling or unbundling from a product design perspective, I would think the current accumulation levels are really low. So to also bundle a healthcare into that really wouldn't be sustainable, and I would rather advocate that the insurance companies come out with health savings solutions, which is quite popular in the region as well, where you have health saving accounts to cater to the specific need of saving towards healthcare expenses post-retirement, which is really integrating savings and risk management together from a product standpoint, and not take that into the NPS framework, because NPS is still not there. I would think the requirement is really critical at this point of time, and insurance companies do have a significant play through general insurance platform or through the insurance platform, which is at its nascent stage. But I think the insurance companies should definitely do their bit in terms of coming out with health saving accounts. The recent health regulations have advocated some thought process is there in terms of the advent of the health saving accounts, and how is that we can model that on platforms that is there already in the region, or even in the US for that matter, because there such policies are quite prevalent, which is having an exclusive focus on saving for health post-retirement, and does have tax benefits as well. So I think that's something for us to look at from a tax incentive standpoint, as well as addressing that specific need in a very focused manner, and not integrate that in the NPS framework at this point of time. It could be something that could be looked up in the future once the pension itself is taken care of. I think we are far away from there.
Okay. Because in India we have an interesting situation, is that we have life and general insurance, as it is called, and there is one school of thought which says that health insurance is a part of general insurance and not life insurance, and there's another school of thought which says that it is a separate, distinct category. So we are wrestling with these kind of thoughts at the moment. Now, one of the classic textbook cases of risk is coming from the US is the Orange County case, where you had a credit rating agency which was helping to rate the bonds issued by Orange County, and the same credit rating agency was rating bonds which were bought by the Orange County. So the same specialist or regulator advising both on the asset as well as liability side. And as far as one side is concerned, the bonds issued by Orange County which were not listed was not under the purview of the Securities Exchange Commission. So this type of regulatory arbitrage or regulatory gaps are there. So I would like to ask Mr. Reddy for his comments on various aspects of regulatory arbitrage insofar as pension is concerned.
Yeah, as it was earlier also said, that few funds are regulated by PFRDA and some are not regulated, some are under mutual funds, some are under the insurance, some products are pension products are issued by the insurance companies. Ideally, all these products have to be regulated by PFRDA. If we are not able to travel that far, probably there should be no regulatory arbitrage between these between these products regulated by various regulators. And if we are able to ensure using the regulatory platform like the FSDC or any other platform, that these products are the regulatory arbitrage is not allowed, probably nobody will have any complaint, and that will also ensure the proper pricing of each of the products.
Okay.
If there is no regulatory arbitrage.
Okay. Ms. Anuradha, do you have any points?
I don't want to say anything controversial. So I think from a regulatory arbitrage perspective, it's really from a principle standpoint, it's really a sense of fairness. And I think that's where the questions on EET and EE do emerge, because you do have comparable platforms which does allow for EE. So at the same time, it's also to look at it holistically in terms of what is this retirement platform helping address. So the EEE, the PF platform from a regulatory design and framework standpoint is a mandatory benefit, and it has certain thresholds and design parameters, whereas the NPS is a larger social security framework that is in place, that is really targeted at growing the pension to the levels that we were looking at in terms of the global pension assets, where currently if we are at 10 or 12% of GDP, if it has to grow to 80-90% of GDP, that's the order of growth and potential that we're talking about. To have a EEE mechanism is going to mean huge revenue losses to the government. So I think it's really about looking at it from a principle and objective standpoint, and also have that sense of fairness to make it really comparable and justifiable, and that can be validated, and really complement each other, like Mr. Reddy mentioned, not view them each other as competition, but really complement each other, because at the end of the day there's so much potential for growth, and it's not as if each one is eating from the other's pie. There's still a lot more to be done, and it's really going to the unaddressed masses and see what is that could be done to enhance the pension savings is something that the regulators need to be thinking about.
Mr. Reddy?
Just I want to make one final point on the pricing. Look at the depository. Always we try to see parallels in the pension industry rather than the other industries. In the depository business, the depositories as such charge per transaction 2 rupees, 10 rupees, 5 rupees, whatever it is. And of course currently it is 5 rupees 50 paisa, 4 rupees 50 paisa to 5 rupees 50 paisa. And the AMC is collected by the depository participants. And we suggest a similar model in the PFRDA also, so that the distributor get incentivized. Instead of CRAs charging then AMC kind of thing, which is 200, 180 or whatever it is, if the AMCs are charged by the point of service, instead of calling it as point of service, it's supposed to be a service, the representative which will be charging AMC, and throughout the year he should be servicing it. If he is not able to service, and as and when the investor chooses to move out to another distributor, he should be refunding part of that AMC. It's that kind of model. Similarly, the CRA should be charging per transaction charges. The law of large numbers work for CRA because there are several transactions are there, and for the distributor, whether it is 200 rupees or 180 rupees or 150 rupees, it is a good amount of money instead of going per transaction charges. And this is what it worked well in the depository business, and we believe that it will work well in the pension industry as well, for promoting the distribution of NPS. This one thought that I thought I should share.
Thanks, Mr. Reddy. We have time for some questions. This is supposed to be an interactive session, and we have time for questions. Not just questions, comments, suggestions, so that we go away with some rich takeaways. We have Mr. Dhruva Chatterjee.
Yeah, hi.
Yes, please.
Yeah, good afternoon, good evening, everyone. My name is Dhruva. So, ma'am, my question is to you. So, you mentioned net pension replacement rates quite a few times. If I look at, say, the OECD data report, Over there, the net pension replacement rates for Indian median earner is roughly about 80%, which compares reasonably well with some of the other markets. Like say South Africa or Indonesia is 14% as per the report. So I was just wondering, what is the model that you are using on which you are saying that the net replacement ratios, pension replacement ratios in India are really low? So I just wanted some perspective on that.
Sure, that's a very good question, and thanks for asking that. So we do something called the Global Savings Attitude Survey, where we look at we as a country, how much do we save? And we do save fairly well. We save around 25% of our income as a percentage of GDP on an annual basis. That's what a sample that we took, and when we asked them what is that they are saving, they said around 25, 26% they save. But if you look at the asset classes that they save in, while replacement ratio, looking at it in a holistic manner, could be the OECD stats. But if you look at the asset classes that they primarily save in, they save it in gold. Not surprisingly, all of us know that India as a country has a fancy for gold. And we save in real estate, we save in insurance, we save in short-term bank deposits. While real estate and gold have been traditionally inflation hedged, when we asked in the research, if people thought if a real estate crash would be a significant risk to their retirement adequacy, people did not foresee that as a risk, which may not be the case, because we have seen these real estate bubbles elsewhere in the world. So when I said the net replacement ratio was primarily from a corporate mandatory benefit standpoint, to say if you just look at these benefits and look at the net replacement ratio coming out of those savings, it is working to suboptimal 30%. But if you look at the other savings, which is the real estate, gold, the insurance investments, etc., that we make, or the short-term bank deposits that we make, then it will be what the OECD stat is. The need of the hour is to invest in diversified long-term inflation-linked investments, and that is the point we're trying to make here. And I'm sure the government is doing its bit in terms of monetizing gold and seeing how we could make gold earn returns rather than just be locked in physical assets. So it is in that context that I made that point, and I think the NPS is an excellent platform to be able to diversify investments for a country that's investing in physical assets or short-term assets rather than long-term inflation-linked assets. So it was in that context I made that point. Thanks for helping me clarify that. Thank you.
Any more? There's one question, lady at the end. Can we reach the mic out to her? Yes, please.
Good evening, ma'am. My question is pointed to you. This is in perspective of corporate programs specifically, because you belong to that area. The current scenario, as we've been discussing through the day, is primarily either DB or DC, where we have gratuity in the DB format and superannuation in certain cases and PF in the DC format. But there have been large corporates who are interested in providing benefits to their employees in various other programs other than just these three. One of them would be the post-retirement medical schemes, where Sir had touched upon, help to the organized sector. But I guess right now most of the employers are facing the issue is where do they invest their liability. I understand that a lot of corporates know that there's a huge liability towards the benefit schemes that they're looking at, but most of them are in their pay-as-you-go format. But there is a lot of restriction in terms of products that are available in the market, or the regulatory framework which does not allow industries to work on a possible framework. I would want your comments on that.
Sure. So I think let's look at it in three ways, three angles. One is what corporates could do. Second, what is employees that they can do, and what third is from a government policy making perspective, what is that could be done. So from an employer standpoint, like I mentioned before, given that there is a liability and there is a sustainability of business that is in context, they can only do so much. At the end of the day, you cannot push employers to do something that doesn't make sense for the business. And you have the mandatory framework in terms of gratuity and provident fund. and you can also have benefits like NPS, VPF, and you can also encourage employees to invest in PPF, etc. So those are mechanisms to think about in terms of long-term retirement savings in the employer context. From an employee standpoint, the issue we are having is that there is a preference for cash, because we are a country with 8% plus inflation over a decade. There is always a preference for cash, and people who are less than 40 or less than 35 really don't see the need for long-term savings, which is something that employers could definitely address in terms of creating awareness and providing messages in terms of how saving early will help demonstrate the power of compounding and show how medical inflation can impact their retirement adequacy, how longevity can impact their retirement adequacy, how inflation can impact their retirement adequacy, etc. So the employers can definitely do that role of awareness creation for that particular segment of employees who is still focused on cash. So I think that's something that from an employer-employee standpoint, things that can be done is provide benefits, facilitate benefits, create awareness. And also employees can look at their savings holistically. And like he mentioned, it's not only about the corporate provided benefits, it's also look at other savings and see what is that they could be doing in the larger savings context to see how they can diversify and have adequate net replacement ratio. From a policy making perspective, I think it's really about incentivizing and making a sustainable framework of NPS, which has to grow beyond the 85,000 odd crores that is there today, and it has to really grow. I think for that, the stakeholders need to feel that there is a business case here for them to do business in this framework. So it has to be sustainable in that sense, and also for the investors or the consumers to be attracted or to be incentivized to save in this framework. So I think those are things that could be done from a policy making standpoint to make this feasible.
There was a thought of pessimism in this room since morning. I was hearing that you need a huge corpus to prevent a preemptive tax on the future generations, because unless you save today or in the form of NPS or in the for your retirement, maybe things are going to go bad. I think we have been living for generations. It's not that NPS is one structured way in which you save for your retirement. Isn't it that our parents who are not public servants or who are not government servants did not lead a good life? They did. They have their own ways of saving for retirement. Need not be in the form of NPS. Now it is a structured way, and we wanted to ensure that the returns are assured by and large, in a sense, and we will be able to lead a very peaceful life. You don't need to worry so much about the post-retirement income. So let's not under the impression that if we don't go for this NPS or NPS kind of things, and things are really going to go wrong. That's not the kind of thought. There are people are saving it, and some people buy 2-3 flats. I'm just giving an example, and the interest in the rental income is one kind of pension, isn't it so? Okay, so this is one way of looking at looking at securing one's future. Now there may be many other ways, many other people are doing it, and but yes, this is one of the products. It's not that we are not saving it, people are not saving for retirement. That is not correct. In fact, way back in Keynes has mentioned, people use it for 3 kinds of purposes. One such thing is the uncertainty, and speculation is the third activity, but uncertainty is one, and post-retirement is an uncertain situation. Many are saving it.
Just right away, Keynes could have been an actuary when he said that I'd rather be approximately right than precisely wrong. Okay, so accuracy is a means to an end. Any more questions? We have time for
yes,
more
just
questions.
one more, last one.
Yes, please.
Yeah, Umesh here, Umesh Jawar with Arihant. Well, I would like to congratulate the panel for coming out with this beautiful, important topic of retirement and pension. And I feel the NPS can become more popular, provided it becomes EEE, and that would bring more salaried class to this NPS system. So that's what I feel. I mean, people can look forward for that. That's what the NPS is not popular so now. So is the association or is the panel doing something on this? I mean, are they talking to the government? Everywhere I have seen, interacted with people, they were talking about making it EEE. That's it. Thank you.
Well, all I can say is that we hope the organizers will write a report and then circulate it widely as possible. Yes. We have time for some questions. Yes, please.
I would just like to make an observation in that context. I think if you look at the debt and the equity markets, and I'm not making any comments here, I'm just making an observation. The equity returns over the past decade, as per the Sensex, and I know there are experts in the room, I'm not the expert, has been probably 15% plus, whereas the debt has always traditionally returned sub 10% returns. So I think rather than advocating EET, we should be advocating higher investment in equity for younger age investors from a pension standpoint, because that will enable the investor to earn more at his younger age. To allow up to 50% in equity investment. And I know after a bit of a again non-adversarial point of view is that after a lot of discussions, PF has come up with a 5% equity investment. So I think that's something to think about rather than talking about the EET, because if the returns improve, then the accumulation can increase to that extent, and it can even take care of the tax element as well. Because at the end of the day, if you think about it from a government standpoint, if the pension funds are going to grow to that size to allow for tax benefits, is something that will mean a real income loss to the government. So if you look at it from a revenue standpoint, I think this could be slightly difficult to make it EE, is my point of view, primarily from a finance revenue standpoint.
There's also a measurement issue here, in the sense that several articles, one article in one newspaper will say, in these X years, debt has outperformed equity, and then next day in another newspaper you will see debt has outperformed equity, and vice versa. Now, if you pick up two different periods, there is always that element of subjectivity. Secondly, what happens is, even if returns by mutual funds or any fund scheme are all published information now, but there also the really pertinent fact is of a particular investor when he gets into a scheme and when he gets out of a scheme. So even in the same scheme, depending on the time of entry and time of exit, the returns are different. So the overall goal here is whether an NPS or any other pension product enables you to achieve your life goals. That's the pertinent question I would like to ask.
Taking a cue from Sanrada, that EET is not encouraging. I think going forward, probably in 2050, someone saying that 30 crore population is going to grow old. Now, how about the government servicing their requirements? The rest of the population will be paying for it, isn't it? Everybody has to pay for the government services. And if they say that their income is tax exempt, but yet equally they have a right to enjoy the government services, then who will pay for it? The other people will be paying for it. So there is no free lunch. Somebody or the other has to pay for the services that the government is rendering, be that security, infrastructure, whatever it is. So I think after a certain threshold level, everybody has to pay for it. That's my view. Today, tomorrow, or any time, everybody has to pay beyond a certain threshold.
And we hope that the tax rates will come down further by the time we get old. So that
yeah.
Because the finance minister has already promised 30 to 25 for corporate. Let us see what he does for individuals.
Yeah.
Any more questions? Yes, please.
My question was pertaining to the investment management aspect of pension funds. Undoubtedly, it's a critical aspect of the overall proposition to the investor. in India, we already have established investment management skills in terms of the mutual funds, in terms of the insurance service providers, etc. My question to you pertains to your understanding of globally, have there been cases where pension funds are able to draw from the expertise of other industries, like in our case, for example, mutual fund or insurance? Have they been successful? And what are the issues and challenges of bringing the same in Indian context? Why is it that Indian investor investing for 40 years cannot invest in our own mutual fund schemes which have 20, 30 years track records?
Like,
I have no clue about it. I don't know about it. If you have something to comment
Anuradha,
on,
after Anuradha, I'll make an attempt.
okay.
Yeah, I'm not the expert, so the only observation I can make, not even a comment, is that if there is existing expertise, it definitely makes a lot of sense to use that expertise. And if you see the Australian market, which I was referring to a lot, there's definitely a cross-pooling of expertise that does happen, and why not in India? And even if you see the current pension fund managers, they've all traditionally come from insurance houses. If you see most of the pension fund managers that are there now, they traditionally have come from insurance companies. And even if you see their operating model, again no quotes, the fund managers do come from the insurance company or from their their mutual fund house only. So they'll have a debt person, they'll have an equity person, and they'll have one manager to oversee these two people, because the costs of operations are such that the expertise is drawn from the mutual fund family or from the insurance family, and companies which are PFMs do come from either of these streams only. So I think it's already happening, but not formally being stated, I guess.
Any more questions?
Good evening. Just to sum up the discussion since we had in the morning, basically everybody is agreeing that in India everybody is underinsured, underbanked, and even under-retired plan. So why not corporates take some initiative and incentivize their employees in terms of a product which is basically pro-retirement, having both a blend of debt and equity. I mean, leaving aside that mandatory part. This is my question. I mean, why don't corporates take initiative in going ahead and seeing the big crisis which is going to come in form of pension-less society? Why don't they take initiative? They reward their employees in terms of a pension plan which is not market driven, which is not driven by NPS, which is not driven by some other kind of investment vehicle, but what do you call that, prudent and savvy kind of management.
Any response? He's saying, why don't corporates take some initiative?
See, I think it's really a question of how should we put this as, it's a dichotomy if you really think about it, because employees want cash, they also want adequate retirement savings. So the employer has to cater to both those requirements, and we do see that there are different segments of employees because typically based on our preference studies that we have done, employees above 40 want more retirement benefits, whereas employees less than 40 want more cash. So I think employers can definitely do their bit in terms of how they deliver their strategy, the benefits strategy, to make it flexible so that it isn't a one size fits all, but it is actually catering to the differing needs of the different employees, and at the same time taking care of the retirement adequacy of those plus 40 employees, and probably bring that down a little so that longer term savings will enable adequate savings as well. So I think that's something that corporates can definitely do, and that's something that we keep propagating to employers also, to make it flexible in terms of a design and strategy.
Okay, I'm also making a guess here that the well-established companies would do something to incentivize their employees because they have to compete for good people. The challenge is whether this will percolate or be a positive rub-off on other companies they deal with, for example, vendors. In their vendor selection program, whether they look at how their employees are covered. So that's the way to push it down.
No, but again, between EPFO and NPS, unless there's a complete switch is permitted, probably some corporates may not come forward to promote this. Like you give an option to the employees to choose between EPFO and NPS. And I'm not too sure. There is some few announcements have come. Whether the regulatory framework is put in place or not, I'm not fully aware of it. Unless that is done, I don't think that that corporates will voluntarily come forward to push these schemes.
Okay, I just revert to the one question raised by the gentleman in the front, that why don't the expertise of the mutual fund be used? This is the practice in the US. 401k has brought in a lot of long-term funds into the mutual fund management industry. As far as India is concerned, there was a lot of resistance of the EPFO investing in equity. There was a resistance, then there was talk about 2%, then there was 5%, and which is actually a large number. 5% of a large number is actually a large number, which could actually be a stabilizing agent, because if you have volatile portfolio outflows, these funds could be a stabilizing agent. And one of the arguments used in order to break that deadlock which was there was one extreme view was that no, these are workers' money. EPFO comes under the labor ministry, and no, there's a global financial crisis. Equity is bad. Equity is evil. That was kind of thought given. But then people just said, look at LIC of India. Okay, they have huge stockpiles. Probably they have purchased shares of Larsen and Toubro, a 10 rupee share at 88 rupees. There was one time when they bought 2 crore shares within a very short span of time. And today that's a huge war chest. So LIC of India is certainly not weaker by investing in equities. And then you have this classic paradox where sovereign wealth funds and foreign pension funds are investing in Indian equity, but if the Indian pension funds are not able to invest in Indian equity, that's a paradox. Okay, so slowly that resistance is going away. So I guess we can be positive about the fact that the pension money is going to come. And some surveys were conducted among senior citizens who have successfully retired and fulfilled their life objectives. And they were told that if you were to live your life again, how would you invest and where would you invest? Many of them said that yes, EPFO has helped them to achieve their objectives. But if I were to live my life again, I would like to have invested 2 to 5% in equities. So there you are. I think it's something which we can wait for. Okay, so if there are no more questions, we can close this session. Can we say that?
Yeah.
Thank you. I just like to point out some of the key takeaways here. One is within the boundaries of EET, if there are certain design elements which we can take care of, we can take care of that. And an important aspect is from what Madam Anuradha said, is that probably when we go back to our drawing boards, we can look at what Latin America is doing so well that we can emulate. And there are certain aspects of pension and insurance coordination which we can look at, that why not the pension funds be allowed to issue annuity products. I don't see any logical reason why. So these are some very good takeaways among others. And as far as regulatory landscape and regulation is concerned, I'd like to draw a lesson from somewhere outside the game of cricket. When the English umpire Dickie Bird retired, somebody asked him to talk about his experiences. So he said, what's the role of an umpire? The role of an umpire is to conduct the affairs on the field as ethically and as much by the rule book as possible without any controversy. And he said that if my name does not come in the newspaper the next day after a test match, it means I've done a good job. Okay, so that is a very good model for regulation. So on that note, thank you most of all to the audience, because you've been a very patient audience, lots of intelligent questions. And of course, thanks to Ms. Anuradha, who took most of the bullets in the form of questions, and Mr. P.S. Reddy for his market perspective. Thank you very much, one and all.
Well, I'd like to thank our panel members as well. What a befitting way to come to the end of the summit. And on that note, I'd also like to invite once again Ms. Sandhya Dhar, Sector Head with Times Conferences Limited, to please come on stage and present the mementos. Firstly, to our panel chair, Professor Sundar Ram Koravi. To Mr. P.S. Reddy. And to Ms. Anuradha Sriram. Thank you once again, and may I please request you to come together for a group photograph as well.